Will it be, as you suggest in your notes, or the question is this the season for year-end rallies, or are we all haunted by the ghosts of Christmases past? We remember last year and what happened just around this time, if a little later in the year. What are you expecting for year-end?
Well, I think that we need to put things in perspective, as you did in your introduction. It's been a remarkably strong year for equities. Most equity markets have had one of their best years in a decade. And if you take equities and bonds together, a kind of balanced 60-40 type benchmark, the best year since the late 1990s. A lot of good news, we think, has already now been priced for next year. And if you look at the rally in equities that we've seen since late August and the leadership of more cyclical parts of the markets, that's really priced in the sort of inflection in global growth that we're expecting. So I think from now, it's much more really about responding to data and perceptions about developments on trade, as you say in your report.
OK, Matt.
Well, it seems like, everybody expected at least phase one of a trade deal to get done. And President Trump has put this into question, kind of. It wouldn't be surprising, I guess, if that was just something he said at a press conference and he really does do a deal, or doesn't put tariffs, the further tariffs on China December 15th. On the other hand, Peter, American voters probably want a candidate, whether Republican or Democrat, to be willing to go up hard against China. And we're getting closer to the election. Is it possible that there is no deal that's going to make these two frenemies closer and even maybe worsen their relationship as we get into campaigns?
Well, I think, Matt, that's absolutely right, that having a relatively tough stance on trade is popular in the US, in the corporate sector, and amongst the population. And I think these tensions and the noise around this topic is likely to continue. I don't think it's particularly likely that we see a complete reversal of the tensions that have built up over the last year or so. Neither do we expect to see a significant ratcheting up either. I think it's just an issue that's going to continue to be on the table over the next several months, and markets will very much move around small perceptions of shifts in one direction or another. But the fundamentals, I think, for risk assets for next year, are reasonably positive. This very long economic cycle, the longest in the US for nearly 150 years, is likely to continue. We don't expect a recession. There may be shifts in perceptions about the risks of trade, but fundamentally we're going to get continued growth with very low interest rates.
And that's interesting. That takes me nicely onto my next question, which was about the state of the US economy. Clearly one of the weaker spots has been that ISM read recently confirming continued weakness or deterioration in the US manufacturing sector. I was looking at a Bloomberg recession indicator that seems to have ticked back downwards in the US, but the New York Fed probability of recession, that does seem to be fairly elevated around that 30% level, which is seen as critical. So why do you have confidence that we don't head into anything that looks like a recession in the US?
Well, we have, of course, as many others do, our own recession probability models, which put the prospects of a US recession at around 20%. But, fundamentally, what are the typical triggers of recessions, and do we have those triggers around at the moment? I would say no. Rising interest rates and inflation expectations, not immediate risk. Collapsing asset prices, we don't think that's particularly likely. With the exception of government bonds, which look very expensive, they're really tied to policy which isn't really shifting. And then importantly, if you look at imbalances unwinding as a trigger of recession, we had that more than a decade ago before the crisis, that doesn't look very much a risk. In fact, household savings are unusually high in the US, and that's true across many developed economies. Private sector debt has actually come down. So we don't really have the typical triggers for a recession right now, and that's why that many of these indicators are still at reasonably comfortable levels.